Okay, ladies and gentlemen, thank you very much for being with me this far. All right, we are now entering into the untamed territory of working capital management. All right, so we are still continuing with the same topic uh, on week one, right? That included the financial management function. That one we've dealt um, with it in the previous two videos. So now let's then continue with working capital management, right? And this should be, I think, the part A of the series. So now, what is working capital? Perhaps we need to understand the theoretical, spheres of working capital. What is it? All right. So, working capital is the name given to net current assets which are available for day-to-day operating activities. And now, when we talk of net current assets, we are simply saying that this is the residual of current assets less current liability. Okay, current assets less current liabilities. So anything that is left there is what is called the net current assets. But I want you to understand something. These two terms come from the statement of financial position, SFP. They come from the SFP and the assets. Okay, the assets. All right. Here we are not talking of the non-current assets, but the um, current assets and current liabilities. So under the assets, we have got the current assets. All right. And these then give us these fellows here, the receivables, the cash, the inventory, right? And then under the liabilities section, we have got the current liabilities. We're not talking of the non-current liabilities, but the current liabilities. And it is in these current liabilities that we have what are called payables. All right. So it's not something new. All right. It's not something new. But what I want you to understand is that the term working capital refers to the difference between current assets minus current liabilities. That's when we get what is called the net current assets. All right, so what is involved in working capital? What is involved? In working capital, we are things like the raw materials, okay, the raw materials, the work in progress, finished goods inventories, and accounts receivable, less accounts payable. We have also left the cash there. Also, cash is involved. All right, less accounts payable. Then that's our working capital. All right. So the size of this net figure has a direct effect on the liquidity of an organization. So this is why it matters, because liquidity is the lifeline of the business. That's the blood of the business. If we do not have the blood, the business is going to be paralyzed, is going to cease to exist. So net working capital of a business is its current assets less its current liabilities. So we have already spoken about this. Let's move on. Now, there is what is called the cash operating cycle. The cash operating cycle uh, is the period of time which elapses between the point at which cash begins to be expended on the production of a product and the collection of the um, of cash from a customer. All right, so the period between that time when we expend cash to produce something, right? That time when we expend cash to produce something, and then the time when we receive cash from our customers. All right? So the connection between investment in working capital and cash flow may be illustrated by means of the cash operating cycle, also called the working capital cycle. So the examiner might try to dazzle you with these terms: trading cycle, cash conversion cycle. Always know that they are referring to this same thing, cash operating cycle. All right? They will be referring to that animal. All right, so we are simply saying that the cash operating cycle is that period of time from the purchase of raw materials, okay, then conversion, right? Um, we convert that material and we get finished goods, and okay, the goods the goods are then sold, right? And customers customers pay, okay, and then we pay our suppliers, and the cycle goes on and on and on. So we are then worried as finance managers to understand how long should this be, this period be. All right, that's that's the idea behind the cash operating cycle. All right, let's look at a manufacturing business cash operating cycle. The cash operating cycle for manufacturing business uh, equals to, okay, let's say we are looking at this cycle in terms of months, the period in terms of month. So we are looking at the average time that raw materials remain in inventory, deduct, less the time taken to pay suppliers, the period of credit taken from suppliers, right? Usually this one is negative, right? The time is negative. And then plus the time taken to produce the goods, right? The time taken to produce the goods. This one is usually the work in progress time, all right? Then plus the time taken by customers to pay for the goods. We are looking at the receivable time, the receivables time, and then the cash cycle. So if the turnover period for inventories and accounts receivables lengthen, that is, inventories and receivable levels increase, or the payment period to accounts payable shortens, that is, the payables level falls, then the cash operating cycle will lengthen and the investment in working capital will also increase. So that is the bottom line. Now, the length of the cash operating cycle is often dictated by the industry. For example, if we look at the construction business, these are likely to have long cash operating cycles because of the high level of work in progress. It takes time to build bridges or buildings. However, restaurant businesses usually have short cash operating cycles because they have short inventory periods and customers pay by cash or debit or credit card. Note also that it is possible to have a negative cash operating cycle. Why should we have a negative cash operating cycle? The bookseller and retailer Amazon has a negative cash operating cycle because of short inventory periods and fast payments from customers. When Amazon ships a book, for example, it charges the customer's credit card and gets paid by the credit card company within a day. So by the end of the day, they are having what is called a negative cash operating cycle. Let's do an example. Any company buys raw materials from suppliers that allow any 2.5 months credit. The raw materials remain in inventory for 1 month, and it takes any 2 months to produce the goods. The goods are sold within a couple of days of production, being completed, and customers take on average 1.5 months to pay. Calculate any cash operating cycle. So we have our formula, ladies and gentlemen, we have our formula. This is the formula page, as you can see there, right? And any, as you can see, is a manufacturing business. So this makes our life easier, right? So let's start with the average time. We can as well ignore this statement. The goods are sold within a couple of days of production being completed. So we can ignore the time at which the finished goods are within inventory because it is negligible, okay? Because the examiner is simply saying that they are sold within a couple of days. So maybe they can be sold within a day or two of production. So we can consider that the time with, the inventory is within the stock is negligible. Let's consider it negligible. All right, so we put our months, right? Let me use a white pen, good. So average time raw materials are in inventory. We are told that the raw materials are in inventory within 1 month, so that's 1.0 months. And then time taken to pay suppliers. We are told that suppliers allow us 2.5 months. Okay, so we have to deduct less time to pay suppliers. That is 2.5 months, right? 2.5 months. And then time taken to produce goods. So time work in progress. This one should be 2 months as given. Takes 2 months to produce goods, right? And then the time taken by customers. So time receivable. This should be 1.5. Okay, because we are told that customers take 1.5 months to pay. So what is the cash cycle? Obviously, the cash cycle, which is the period taken to get cash into our hands. The period taken there, that's 1 minus 2.5, that's minus 1.5 plus 2, that is 3.5. Okay. Let me use a calculator there. Okay, so we get 2.0. Okay, so that's the time we receive cash. So the current cash operating cycle is 2 months. Right. Now, the financing of working capital. Whatever level of working capital the business decides to hold, it has to be financed from someone. The business must decide whether to use short-term or long-term finance. Long-term finance is either raised from equity in the form of share issues, or from long-term borrowing. Short-term finance generally involves overdraft borrowing and or delaying, payment to payables. Short-term finance is often cheaper, although not always. Interest rates on overdrafts can be very high, and delaying payment to payables can involve the loss of discounts. However, short-term finance is risky as it is repayable on demand. So there are some liquidity implications. All right, if we resort to short-term finance, we need to be careful because when it is wanted, it is wanted upon demand. So that's where the risk is. It is repayable on demand, there and there. The moment you make a deposit, they take their money. Okay, that's the idea. Now, in the past, it was generally thought that since working capital involved short-term assets, it should be financed by short-term finance, whereas non-current assets, being long-term, should be financed by long-term finance. A more modern view is that, in fact, the overall level of working capital remains fixed in the long term, permanent, that is permanent working capital, and that there are day-to-day fluctuations above this permanent level, that's temporary working capital. Permanent working capital, being long-term, should be financed by long-term sources of finance. Temporary working capital, for example, if shop is increasing its inventory in preparation for a holiday period, should be financed by short-term sources of finance. Okay, so those are the underlying assumptions. How do we measure uh, the achievement of corporate objectives? As part of the system of financial control in an organization, it will be necessary to have ways of measuring the progress of the enterprise so that managers know how well the company is doing. Remember, we talked of the objectives being smart, if you still remember, that the corporate objectives should be smart, and that's when the aspect, that's where the aspect of measurability is coming from. A common, a common means of doing this is through ratio analysis, which is concerned with comparing and quantifying relationships between financial variables, such as those variables found in the statement of financial position and statement of profit or loss of the enterprise. So we have got four main categories of ratios, right? That's the profitability and return ratios, the debt and gearing, liquidity, shareholders investment ratios. Okay, the key to obtaining meaningful information from ratio analysis is comparison. Comparing ratios over a number of periods within the same business to establish whether the business is improving or declining, and comparing ratios between similar businesses to see whether the company you are analyzing is better or worse than average within its own business sector. So we also have the DuPont system, which can assist you. You can refer to this pyramid uh, in your computation of ratios. For example, if you want to calculate the asset turnover, your asset turnover is equal to sales over total assets. As these are the sales, these are the total assets, and the divide sign is there. So you can see that asset turnover is found by sales divided by total assets. And when you talk of total assets, if you go down the pyramid, you can see that total assets is non-current assets plus current assets, right? When you talk of net income, we are saying sales minus total cost. Then we get the net income. And this net income is what we have been referring to as the earnings attributable to shareholders. Are we together? So that's how you use the DuPont system. The return on equity, ROI, is given by a return on investment multiplied by total assets divided by equity. All right, and you can as well continue analyzing this. All right, and a return on investment is given by return on sales multiplied by return on assets, and go down and go down as well. So that's the DuPont system for you. However, these ratios are also given separately in these notes. All right. So if we look at the liquidity ratio there, all right, liquidity ratio, we have got the current ratio, it's given there, as well as the quick ratio. The current ratio is found by current assets over current liabilities. We would normally expect this to be greater than 1. We want a current ratio that is greater than 1. All right, so a current ratio of less than 1 could indicate liquidity problem. For example, it would be difficult to keep suppliers who are owed $10,000 happy if the business only has $1,000 in the bank or coming in from customers. So if we are expecting only $1,000 in the next month, when we are owing or we are having a current liability that is due next month of 10,000, we should be worried because we are going to fail to repay the loan. Now, because the current ratio involves all the current assets, and remember, when we talk of current assets, we are referring to all those items like inventory, receivables, and cash. Okay? But this measure is not going to give us much comfort. We need to be more precise because remember, we are worried about our liquidity status. Sometimes the inventory might be difficult to sell. So, in as much as we might be having a lot of inventory, we might end up failing to pay our creditors. Why? Because we have failed to raise the much needed money. So the quick ratio gives us more insights. So this one is the total assets less inventory. We are now removing the inventory. Why? Because the inventory is not that liquid. In as much as it can be sold, sometimes it might take time to sell that inventory. So we need to remove it from the picture if we are calculating the quick ratio. So we remove the inventory from the total current assets, then we divide by current liabilities. So the same idea is the current ratio, but without the inventory, on the basis that it is inventory that will take the longest time to turn into cash. Clearly, the quick ratio will be lower than or equal to the current ratio, and a quick ratio of slightly less than 1 is not necessarily dangerous. It very much depends on the type of the business. So if the quick ratio is not much less than 1, we shouldn't be worried. Why? Because we still have the inventory, but we do not factor it in. Why? Because we assume that it is less liquid, or it takes time to become liquid. All right, but we still have the comfort that the inventory is there. All right, efficiency ratios. All right, so these ones now gives us more insight in how efficient we are in bringing our inventories or receivables into cash. How efficient are we? All right, so this shows let's start with the inventory turnover. This shows how quickly inventory is being sold. So inventory turnover is equal to the cost of goods sold per annum divided by the average inventory. All right, so that's the purpose of that ratio. Receivables turnover, this one is credit sales per annum divided by average receivables. Sometimes you'll be given the opening and closing receivables, you then have to add them and divide by 2 to get the average figures. So the receivables turnover shows how quickly debts are being collected. What about payables turnover? This one is equal to credit purchases per annum divided by average payables. Number of days of inventory is equal to average inventory over cost of sales per day. Cost of sales per day. So you get your number of days of inventory. This shows how many days supply inventories, how many days supply of inventory there is. Receivables days is equal to average receivables over sales per day. This shows how many days of credit customers are taking on average. Remember, the sales we are looking at here are these are credit sales. Do not include the cash sales in that formula. Payables days is equal to average payables divided by purchases per day. And once again, these are credit purchases. Okay, let's look at the shareholders' investment ratios. Here we have got the dividend yield, the earnings per share, we've spoken about that one, the price earnings ratio, and the dividend cover. Returns to shareholders are obtained in the form of dividends received as well as capital gains from increased market values. A company will only be able to raise finance if investors think that the returns they can expect are satisfactory in view of the risks they are taking. We must therefore consider how investors appraise companies. We will concentrate on quoted companies. Now, quoted companies are listed companies. So don't be hoodwinked. Listed companies. Information that is relevant to market prices and returns is available from published stock market information, and in particular from certain stock market ratios. Now, cum dividend or cum div means the purchaser of shares is entitled to receive the next dividend. So cum means before dividend. Bear this in mind. Ex-dividend or ex-div means the purchaser of shares is not entitled to receive the next dividend. So this one is after dividend. So cum div means before the dividend. Ex-div means after the dividend has been paid. The relationship between the cum div and ex-div is market price per share ex-div is equal to market price per share cum div minus forthcoming dividend per share. When stock market price, share prices are quoted, shares go from being cum div to ex div on a given day, and shareholders buying the shares from the time they go ex div are not entitled to the next dividend payout, which will happen soon. So, as an investor or finance manager, you need to have that appreciation. Let's talk of the dividend yield. Dividend yield is equal to dividend per share divided by ex-div market price per share. Okay, ex-div, we say that this is the after dividend market price per share. The dividend yield is the return a shareholder is currently expecting on the shares of a company. The dividend per share is taken as the dividend for the previous year. Ex-div means that the share price does not include the right to the most recent dividend. Shareholders look for both dividend yield and capital growth. Obviously, dividend yield is therefore an important aspect of a share's performance. Let's compute this example. In the year to 31st March 22, an advertising agency declares an interim ordinary dividend of 7.4 cents per share and a final ordinary dividend of 8.6 cents per share, assuming an ex-div share price of 315 cents. What is the dividend yield? What is the dividend yield? And we have said that the dividend yield formula, the dividend yield, okay, we talked of the formula. Dividend yield is equal to dividend per share, all right, divided by the ex-div share price. The ex-div share price or market price per share. Okay? So the total dividend, because this dividend is actually the dividend per share is the total. All right? So total dividend. So the total dividend is equal to we first paid 7.4 cents, the interim means during the year, and then 8.6% was the final dividend. So we need to add those two figures, 7.4 plus 8.6. What do we get? Obviously, we get 16 cents, isn't it? So we then have to slot this into our formula. So therefore, dividend yield is equal to 16 over the ex-div share price of 315. So what is the dividend yield there? That is 5.1%. Please confirm with your calculators. Okay, let's move on. In the exam, you need to have fire. You need to move. Otherwise, you will fail just based on time management. All right, the EPS and price earnings ratio. Earnings per share is equal to profit distributable to ordinary shareholders, that is the earnings attributable to shareholders, divided by weighted average number of ordinary shares. Okay, we have discussed much about the earnings per share, so we just have to move on. Let's talk of the price earnings ratio. The price earnings ratio is equal to market price of share divided by EPS, right? Market price of the share divided by the earnings per share. So the price earnings ratio is a useful yardstick for assessing the relative worth of a share. This is the same as total market value of equity divided by total earnings. All right, so here we are looking at a single share and a single earning of the share, but we can as well look in terms of market capitalization, where we look at the total market value of equity divided by the total earnings. The value of the PE ratio reflects the market's appraisal of the share's future prospects. It is an important ratio because it relates two key considerations for investors: the market price of the share as well as its earnings. Let's compute the PE ratio from the scenario. A company has recently declared a dividend of 12 cents per share. The share price is 3.72 kun div, and earnings for the most recent year were 30 cents per share. Calculate the PE ratio. Okay, the PE ratio, and from our formula, we are told that the PE ratio is equal to market price of share, right? Market price of share over EPS, right? One thing, the market price should be ex-div. All right. The market price should be ex-div. So our PE ratio, the PE ratio is equal to market value ex-div divided by EPS. So market value ex-div, we are simply saying the market value cum div less the dividend minus the dividend. The dividend is 12 cents, so 0.12. All right, divided by the earnings per share of 30 cents. So this should give us 12. Okay, so the 12 there is not in dollars, right? It is in times. So the XD price should be used when you do the computation of the PE ratio. All right, so that's it. So the examiner might go further and say, what does the PE ratio of 12 times, which you have calculated, say in part A, mean? What does that mean? Okay, so this means that investors are prepared to pay 12 times more for each dollar of earnings obtained last year. The investors are prepared to pay 12 times more. So this is why this ratio is important in valuing shares. It's a very important measure in valuing shares of companies. The PE ratio. It's very, very, very important. The investors are prepared to pay 12 times for every dollar of earnings sustained or achieved in the previous year. Okay, let's then conclude our lecture with this aspect, the limitations of ratios. We have talked of ratios, right? Many ratios there, but I think we have not covered some ratios there. The profitability, okay, profitability they can be found there as well. The ROS, all those, right? But do not worry, they are not much of a headache. Okay, some of the ratios you just have to refer to the notes which we've given you, right? Those aspects, we'll cover them in the next video. Let us stop here for now. Okay, let's stop here for now. We'll cover a lot of ratios as we proceed with this module. Do not worry for now. Okay, do not worry. Just have to remind me if you find some ratios which are troubling. But as you can see, these ratios are just, a revision of other modules which we have already covered so far. Okay, so don't worry about them, right? Because we do not talk of the gearing and so forth, but don't worry for now. So the use of statement of financial position is dangerous in that they represent only one point in time, which may be unusual due to, for example, seasonal factors. Remember, if a statement of financial position, the SFP, is a snapshot, it is a snapshot of figures at a particular point in time, because it is a statement as at a particular point in time. So it could have ignored seasonality. Okay, seasonality could have been ignored. There may be some window dressing. Remember, these are accounting matters. So accounting conversions, remember when we talked of the aspect of profitability versus shareholder maximization, we hinted that accountants might manipulate the figures. So this is why you see certain companies which have been reported as profitable end up being bankrupt. Why? Because profitability is not always shareholder wealth maximization. Then they should they only look at the past, not the future. So ratios are, historical in nature. They are not futuristic. So in that manner, they are of less importance. They are of little value unless used in comparisons. So you need to then compute a ratio with a comparison or a comparative figure. Otherwise, your computations might mean nothing. Okay, so with that said, ladies and gentlemen, I hope you have enjoyed the lecture. Stay with me again in the next video where I will take the aspect of working capital management a step further because we need to look at receivables management, inventory management, a lot of things. So please be with me as we proceed. All right. Until next time, ladies and gentlemen, may you continue to feel excited. I mean, very, very excited. Thank you. I'm signing out.